You have a 60% expense ratio here, and the 8.29% is predicated on your post-reno net operating income. So I would say it's a little bit misleading that you're actually getting an 8.29% cap rate, because that's going to take you at least 12 months, but more likely 18 to 24 months to get to that point. Because if
Okay.
you think about it, you're not going to go in there and the day you close, you're not going to raise the rents and bring it to
Yeah.
900 and 1,000, right?
Yes.
You
Definitely
you
not.
will have lease turnovers, and so just looking at the rent pro forma, I'm sorry, the rent rolls. I'm sure he's renting apartments every month, so it's going to take you at least 12 months to vacate that unit and put a new tenant in there at a new
Mm-hmm.
higher rate, or if that tenant is willing to come up to the market rate, right?
Yeah.
You're
Mm-hmm.
going to have vacancy if the tenant says, no, I'm not willing to pay the extra money, number one.
Mm-hmm.
More than likely, you can't bring them to the post reno because you have to do the renovation. So now you're going to have a unit that's down for 2 to 4 weeks, depending on how extensive the renovation is going to be, how fast the contractor does the work, all of
Mm-hmm.
that. And then you may have another one or
Yeah.
2 weeks before you actually sign a lease with somebody and they move in. So you could have anywhere between 1 to 2 months of no income from that apartment before you
Mm-hmm.
rent it at the current market rate. And then, by the time that cycle fully finishes, it could be 18 to 24 months from the day that you close, right?
Mm-hmm. Yeah.
So,
Yes.
best case scenario, you're buying it at the current net operating income, which seems a little
Mm-hmm.
inflated to me because I don't think he's putting 256 in his pocket. Because you also have a debt service that you have to factor into this, right? The
Yeah.
debt is not included in that net operating income. So
Mm-hmm.
this cap rate, if we really wanted to calculate this, instead of that, if I was to say, okay, let's move this over to that. So if we were to say current market rate, so it's not post reno, but current market rate, it only brings it to a 6.6% cap rate, which it's a little like too much in favor of the seller. I don't think this property is a 6.6% cap rate property. This is a very solid C class property, you know,
Mm-hmm.
and that should be trading at 8.5 to 9% in this market, not
Okay.
6.6%. Okay, so having said that, we need a discount to buy it, right? So just keep that in the back of
Mm-hmm.
your mind. Okay, so now you have the 2.9 is all in. That's assuming that you have a $2.6 million offer plus $300,000 in capex. Uh, your offer price is actually 2.6. So how did it calculate this? Actual cap rate is F42, which is this number divided by E51, which is this number, plus E46, which is this number. Okay, so eh, I kind of, yeah, I see what they're doing there. But again, I think that's a little aggressive to calculate it that way, because you're basing it on your post renovation, fully rented. I mean, well, not fully rented because you have a vacancy contingency in there, but fully renovated, and everybody's paying, that's renting the place is paying like the full rent that you could possibly collect from them. That's going to take you a long time to get there. So I think that that's a little aggressive, just personally.
Okay.
So going down, so you have a purchase price 2.6. Sorry, did you have a question?
No, no, no. I was saying okay.
Okay.
Yeah, yeah.
So 2.6 plus $300,000, that's 2.9 million total all in. You have an acquisition cost, 2%. That's reasonable. Cash reserves, okay. Acquisition fee, 2%, okay. Total funding is just over $3 million, 3.03. You're going to have a 70% loan to value. So that's 2.3. Did it calculate that? Okay, I guess it did calculate that. If you're trying to raise $1 million, why is there nothing for the loan? 6.5% interest, okay. 360 seller finance debt service. Annual debt service. Okay, is he going to seller finance this?
No, 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 no.
So why do we
So
have?
I guess they just share all the different options, right? When you submit the deal to the underwriting team for RAI, they just
Yeah.
put everything in there. And I suppose Bo was telling me that they're still trying to pick that particular part at the moment. So maybe like new deals and stuff, she was telling me, giving me a little background. So I guess we need to still work it out at least.
Okay. Okay, fair enough. Okay, so you have 24 months of interest only, and then you have partner equity of $1 million. You're offering 8.5% preferred. That's very solid offer for the investors. So your annual cash flow, current post closing with interest only, is $39,000. So that's debt service plus right. So it should be G42, which is your net on your current, which I don't think is going to be. I mean, that's assuming that everything is true that he tells you. You're going to net 40,000. So you're cash flow positive, which is okay. Cash flow pro forma with IO. Why is this only 23,000? Yeah, because your cash flow is much lower. Okay. And then cash flow pro forma after IO is only $1,382. Yeah, and see this is time period to reach potential rents pro forma. It's only 12 months here. So that means that within the first year, you have to reach I don't know which number it's using there, but you'd have to reach a very high number in 12 months as far as collected rents. I don't think that that's going to be truly practical. So let's just leave it at that for now. Let's just go through the rest of it and then we'll adjust some numbers and see what that does. So you have a 7 cap. You're saying you're going to have a 7 cap at refinance time. Stabilized value is going to be 3.4 million with a 7 cap. Okay. Your loan to value is going to be 65%. So that's how much you're going to get the loan for. That's the refinance cost of the loan. That's the original loan payoff. I don't know how quickly you're refinancing here, but let's assume it's 24 months, within 24 months. Okay. Net proceeds, $157,000. So you're not returning a whole lot of money on the investor capital. Normally, when you refinance, you want to return at least 60 or 70% of what the investors put in, and you're only returning 16%. So relatively speaking, that's not, from an investor standpoint, it's not going to be favorable to them. So think about it this way, right? You put $100,000 into a deal, and I tell you that in 2 years, I'm going to pay you 8.5% each year on your money. So you get $8,500 every year as your preferred return on the 100,000 that you put in. Okay.
Mm-hmm.
So you would get $17,000 over 2 years. But when I refinance
Mm-hmm.
my property in 2 years, I'm only going to give you another $16,000 back in your hand. So yeah,
Mm-hmm.
you have $17,000 plus $16,000, but that's only $33,000 you're getting back after 2 years on your original $100,000 investment. And then essentially you're holding this property, let's say, in perpetuity, right? Which means forever, because you don't know
Mm-hmm.
when the next refinance event you're going to have. Because if you just refinance it, you may have to wait another 5 years before you can get the rents up enough to justify another
Mm-hmm.
refinance, right?
Yeah.
So
Yeah.
I paid $100,000. 2 years later, I get $33,000 back. And yes, every year, if things go well, I should be getting $8,500. But if you're saying, okay, now it's 100,000 minus 33,000 is $67,000 divided by 8,500. It's going to take me another almost 8 years to get my additional money back. Um, and now I'm like, basically I have my equity share in the asset, right? So this is like a 10-year plus play for somebody to really make money on this deal. And it's not
Mm-hmm.
bad. There's some people that would say, okay, that's fine. Like I'm willing to do that. I like the security of being able to put $100,000 and get $8,500 back every year. So okay, and then after 10 years, I get my original $100,000 back, right? You can kind of
Mm-hmm.
think about it that way. But some people may not like that. This is going to be a harder
Yeah.
sell for somebody that's going to be investing in a real estate asset versus just putting $100,000 into the stock market and saying, okay, it appreciates 8.5% annually, right? Or you
Mm-hmm.
put it into some other investment vehicle that pays you 8.5% annually, and you still have your $100,000 every year. You see what I'm saying?
Yeah.
Okay.
Yeah. Yeah.
So if we keep going, you see your annualized rate of return is 11.5%, which tracks to what I said, which is it's going to take you almost, it's my math said 8 years ish, and I rounded it up to 10 to get your money back. And that's what your annualized return is basically saying, is it's going to take you 10 years to get, or eight ish years to get your money back, or to double your money, basically. So
Mm-hmm.
10-year cycle
Mm-hmm.
to double your money, not bad, but it's not great either.
Okay.
Does that make sense? Do you understand what I'm saying? Okay.
Yeah. Yeah. I understand. Yeah.
Okay. So now let's do some really cool stuff, and let's play with this number here, which is the time period to reach pro forma rents, right? So it says 12 months, but let's be a little bit conservative here. And let's say it takes you 18 months to reach that. You're getting a 10.5% annualized rate of return now, assuming all the other numbers stay the same. Um,
Mm-hmm.
it didn't change the refi very much. I don't know if this calculator is broken, because it seems like the only thing it's adjusting is the annualized return. Um, it should, because what's going to happen is if it's going to take you 18 months to reach your pro forma rent, your stabilized market value is going to be much less, because it's going to take you longer to get to that point, right? So if you start at let's say the value is 2.6 million, and it's going to in 12 months reach 3.5 million, because you're going to reach your pro forma in 12 months. Okay, that's one rate of increase. But if it's going to take 18 months, then in 12 months, you won't reach the 3.5 million. You'd only maybe be at 3.1 or 3 or 3.15, right? So your
Mm-hmm.
your
Mm-hmm.
refinance at that point is going to be much different, and you may actually be in a position where you can't refinance in 2 years, because you don't have enough equity built into the asset by that point because you haven't been able to raise the rents enough to justify a refinance.